Hi everyone. So this is the third video of section E in CMA part 1. Section E is about internal controls, you know that. In the first video of internal controls, we have seen corporate governance and the elements of corporate governance. Now in the second part, we saw internal controls, components, principles of internal controls, and safeguarding controls, transaction controls. We have seen all that. Now let's see legislative initiatives about internal controls. Basically, regarding internal control, what are the regulations? What are the legal requirements available in the USA? Legislative initiatives on internal control. There are a handful of legislative initiatives regarding internal control issues. Two that we need to know. One is FCPA, the Foreign Corrupt Practices Act. Two, Sarbanes Oxley Act. Let's see one by one each of them. The Foreign Corrupt Practices Act. This act was passed in response to the discovery in the 1970s that American companies were making large, questionable or illegal payments to foreign governments, government officials or politicians. So this is mainly targeting making payments to government officials, government politicians. Why companies might make payments to government officials? Mainly to obtain the contracts. To obtain the contracts, they bribe. So this FCPA was passed to avoid, to stop the bribery to government officials. This is an amendment to 1934 Securities Exchange Act. There are two main provisions. One is anti-bribery provision. Two, internal control provision. Applicability and responsibility. The anti-bribery provision apply to all companies whether or not they are publicly traded and registered with SEC. So, doesn't matter a company is registered with SEC, whether it is a publicly traded company, listed company, doesn't matter. Even to private companies, these anti-bribery provisions apply. The accounting provisions are applicable only to companies that are under the regulation of the SEC. Accounting provision means the second provision. What is that? Internal control provisions. This is applicable only to companies that are registered under Securities and Exchange Commission. That means publicly traded companies. The responsibility for compliance with the act is given to the company as a whole. That means everyone in the company is part of the responsibility. The responsibility is not placed with a specific person or position, but with everyone within the organization. However, individuals are personally liable for their own actions. So, the whole company is responsible. Not a single person is individually responsible for the implication of the application of this provision. However, any person who is doing such act like bribery, he is responsible for his act as well. It is illegal to offer or authorize corrupt payments to any foreign officials, foreign party chief or official, or a candidate for political office in a foreign country. It is also illegal to make these payments through another party. It might, sometimes, companies might route the payments. First, the payment is given in a legal way. But if you see the final destination of that payment, it reaches the foreign officials, foreign governments. So still it is illegal. A corrupt payment is one that intends to cause the recipient to misuse their position in order to direct business to the payer of the corrupt payment. So this is the thing, in order to direct business to the payer of the payment. That means to award the contracts, to provide the businesses, to give the licenses, to give the approvals. A payment is corrupt simply by the fact it's made. Even if the benefits that were expected are not received, the payment was corrupt. That means expecting that the government official will award you with the contract or will give you the license, you have made the payment. But later you did not get the license. Still, the payment you made is corrupt payment. It is bribery. So finally, whether you achieve the business or not, whether you got the contract or not, doesn't matter. Second provision, internal control provision. Management must also develop and implement a system of internal controls. Management is required to maintain records and books and accounts that represent transactions properly. So this is quite common. We know this already, internal controls. The logic is that if the company has an effective internal control system, it will be more difficult for corrupt payments to make. So if you are maintaining records properly, if you have proper systems to make the payments, authorize the payments, there are multiple parties involved, like segregation of duties is there, then making foreign payments, making foreign corrupt payments will not be easy. So that's all about FCPA we have. Once again, quickly we will recap. Foreign Corrupt Practices Act. It has two provisions, anti-bribery and internal control provision. Anti-bribery says any company, whether it is public or private company, it cannot make any payments of corrupt payments to foreign officials, foreign government officials. Internal control provision says all the companies that are registered with SEC, this is applicable to SEC, all the companies that are registered with SEC, that means public companies, must have proper internal control systems. Done. Now we are coming to Sarbanes-Oxley Act, SOX. So after the failure of Enron, WorldCom, such big companies, they passed this act known as Sarbanes-Oxley Act, emphasizing on good corporate governance, ethics, internal controls, emphasizing on these areas. They passed this act, Sarbanes-Oxley Act. So first we will see the sections, names of the sections. Title is PCOAB, Title 1. Title 1 is PCAOB. We will see that in detail later. 201, services outside the scope and practices of auditors. 203, audit partner rotation. 204, audit reports to audit committees. 302, corporate responsibility for financial reports. 404, management assessment of internal controls. 407, disclosure of audit committee financial expert. These sections we need to know for our exams. One by one we'll see. Public Company Accounting Oversight Board, PCAOB. So Sarbanes-Oxley Act established the PCAOB. What is the purpose? To oversee the auditing of public companies that are subject to the securities laws. Now you see, there are public companies. These public companies are audited by audit firms. Whether the public company maintained all the evidences, whether they have recorded the transactions according to the US GAAP or IFRS, the auditor is going to check. And they give a opinion finally, whether this financial statements of this company provides a true and fair view of the company. Now my question is, who checks whether the auditor has done the work properly? There are audit procedures. Whether the auditor has done everything properly, whether the audit opinion is reliable or not. How do we say that? That is what this company is going to do. This organization is going to do. Which one? Public Company Accounting Oversight Board. So what they will do, when companies submit their reports, financial statements, annual reports to SEC, so this is already account prepared, already audited, now they are submitting it. This PCAOB will randomly cross-check the accounts. They will double check whether auditing exercise has been done properly. Right. So this is the meaning of accounting oversight board. Basically, they are overseeing the auditing process. So this board contains 5 board members appointed by SEC. Includes only members who are financially literate and must be from the private sector. Only 2 of the board members can be CPAs. So out of 5, 2 can be CPAs, 3 cannot be CPAs. The PCAOB has many responsibilities. Its role to provide guidance to auditors on the auditing of internal controls is just one responsibility. Auditing of internal controls is one responsibility. Responsibilities of PCAOB. Registering accounting firms that audit public companies. So the audit firms that are auditing public companies must be registered with PCAOB, must come under PCAOB. Establishing standards related to the preparation of audit reports regarding auditing, quality control, ethics, and independence. See, regarding auditing, quality control, ethics, and independence, they establish standards. Conducting inspections of registered public accounting firms with the Sarbanes Oxley Act, the rules of the board, the rules of the SEC, and other professional standards. So basically, checking the audit firms whether they are running according to all these. Enforcing compliance with appropriate laws and professional standards relating to audit reports and the obligations of accountants for them. Again, see, emphasizing on the compliance of law for the audit firms. Conducting investigations and disciplinary proceedings and imposing appropriate sanctions in case, when an audit firm did not follow the procedures or it did not comply with the regulations, then conducting an investigation and disciplinary proceedings. Management of the operations and staff of the board. Management of the operations and staff of the board. Board means this board. Okay, so managing this board. Other services. Now we are coming to another section. All this time we were looking at Title 1. This is done. Title 1, PCAOB. So what is PCAOB? What do they do? What are their responsibilities? Done. Now we are coming to this section. Services outside the scope and practices of auditors. That means an audit firm to a PLC, if they are doing the audit activity, can they provide any other services to this PLC like accounting services, valuation services, transaction advisory services? Can they provide anything like that? Let's see what the Act says. In order to maintain auditor independence, Section 201 lists specific non-audit services that create fundamental conflict of interest for the accounting firms. That means this list of activities they cannot provide. If you are providing audit services to a client, listed company, we are not talking about private company, listed companies, an audit firm, for example, say KPMG. KPMG is providing audit services to a listed company, public company. Then KPMG cannot provide these services to that public company. What are these services? Bookkeeping services. Of course, if you're auditing, you can't do bookkeeping also. Then it's like self-review. You do the bookkeeping and you do the audit as well. Not appropriate. Financial information systems design and implementation. Again, it will be a self-review. If you are the one who is designing the information systems and then you are going to audit that, how? So you can't do that. Appraisal or valuation services. Actuarial services. Actuarial services means, valuation of pension funds and all that. So that's not allowed. Internal audit outsourcing services. Some companies give their internal audit to a third party. So this external auditor cannot do internal audit also for the same company. Management functions, human resource services, broker, dealer, investment advisor, investment banking services, legal services, expert services unrelated to the audit. For example, taxation related advisory. Any other services that PCAOB determines is not permissible. So all these activities an auditor cannot give to their client. Next section, 203, audit partner rotation. The lead audit partner and the concurring review audit partner must rotate off a particular client's audit after 5 years. Remember this. Right? The lead audit partner. That means, the audit firm might assign a team, let's say a 5-member team to a client, a PLC. So one of these guys is going to be the audit lead partner. This guy cannot be the lead partner to this company for more than 5 years. They must remain off that audit for another 5 years. So to reassign to this company again, 5 years they can't be. So 5 years they can work on this audit. Then another 5 years, no. After that, if they want again, they can be assigned to this for 5 years. So cooling off period 5 and maximum length 5. 5 years, 5 years. Other audit partners, that means not the lead audit partner, others who are part of the engagement team must rotate after 7 years. 7 years. So maximum 7 years they can work for an audit for an audit client and remain off for 2 years. The cooling off period is 2 years. So lead partner 5 years, 5 years. Other partners, other audit partners 7 years, 2 years. Specialty partners do not need to rotate off. Specialty partners do not need. Specialty partners means sometimes when this audit team provides the audit services to the client, they might have needed advice from an expert, for example, regarding taxation. They needed some expert advice. So they have got it from another person, somebody not in the part of their team. Another tax expert in their audit firm gives advices to this team. So that's meaning of specialty partners. You don't have to rotate them. Examples of specialty partners are tax or valuation specialists. Examples of specialty partners are tax or valuation specialists, partners who consult with others on the audit engagement regarding technical or industry specific issues. So such people need not be rotated. They can remain connected to this partner, connected to this auditor and client on a regular basis. Other partners who serve as technical resources for the audit team and are not involved in the audit per se are also not required to rotate off. So those who are not part of the regular audit team need not rotate off. That's the summary of this. (204). Let's see, go back and see the list we had. 201 finished, 203 finished, audit partner rotation. 204 auditor reports to audit committees. Then we have another 3 sections. 204 auditor reports to audit committee. Auditor must report the following in a timely manner to the audit committee. You remember what is audit committee? From the board of directors, you choose non-executive directors, at least 3 of them, and make an audit committee. Both internal and external audits will come under audit committee. Internal auditors directly report to the audit committee. External auditors also, if they have any issues, conflicts, anything, they will approach the audit committee to get it resolved. So the external auditor must report the following in a timely manner to the audit committee. All critical accounting policies and practices to be used. All critical accounting policies. All alternative treatments of financial information within GAAP, generally accepted accounting principles, that have been discussed with the issuer's management. Sometimes, if you have different approaches possible, the auditor might have discussed with the management and decided to apply one of those methods. So that has to be reported to the audit committee. Other material written communication between the registered public accounting firm and the management of the issuer. So whatever the written communication they had, the auditors with the management, should be reported to the audit committee. 302. Corporate responsibility for financial reports. Each annual or quarterly report that is filed or submitted in accordance with the Securities Exchange Act must include certifications by the company's principal executive officer or officers and its principal financial officers, CEOs, CFOs. Sometimes companies might have multiple CEOs, multiple CFOs. So they have to give a report, certifications. So in the annual report, that must be included. Let's see what is in the certifications. The signing officer certify, that means CEO and CFO certify. Each signing officer has reviewed the report. The report does not contain any untrue material statements or omit to state any material fact. So they give a certification that the statements do not miss any information, do not omit any information. To the best of the officer's knowledge, the financial statements and all other related information in report are fairly represented. Fair representation when all material aspects of the financial condition and results of the operations. The signing officers certify that they are responsible for establishing and maintaining internal controls. They have designed that internal controls to ensure that they are made aware of all material information relating to the company and all subsidiaries. Have evaluated the effectiveness of the company's internal controls within the previous 90 days. Have reported on their findings about effectiveness to the internal controls. So basically they have to give a certification. They have good internal control systems which have been reviewed recently and everything documented. The signing officers have disclosed to the company's auditors and its audit committee of the board of directors all deficiencies in the design and operation of company's internal controls and have identified for the company's auditors any material weakness in its internal controls. So if the internal control system had any weaknesses, any deficiencies, any shortages, they have been identified and discussed with the audit committee. Any fraud, regardless of how material it is, that involves management or other employees who have a significant role in the company's internal controls. That means whether small or big, any fraud has happened in the company, that must be reported to the audit committee. So in the certifications, what is certifications? CEO and CFO, they sign a document saying that all these points, first one, they have reviewed the report. They are sure that the information in the report are true and fair. Nothing has been missed. Then another section about internal controls. They think they have sufficient internal control policies and procedures. It is being reviewed time to time. Within the last 90 days, they have reviewed it. Any shortages, any inefficiencies they found have been reported. Finally, any frauds involving the employees of the company have been reported to the audit committee. All this they confirm in that certification. 404, assessment of internal control. There are requirements connected to the assessment of internal control for both management and the auditor. Requirements of the management must include in the annual reports a report of management on the company's internal control over financial reporting. Sarbanes-Oxley requires the report to state the responsibility of management for establishing and maintaining an adequate internal control structure and procedures for financial reporting. Contain an assessment by management of the adequacy of the company's internal control over financial reporting. This includes both scope and capabilities of internal control structure. So management has a responsibility for establishing and maintaining an internal control and to do an assessment whether the internal controls are sufficient. This is for the auditor, must report on and attest to the management's assessment of the effectiveness of the internal controls. So they must evaluate the assessment of management, whether management has done a proper evaluation. 404 provided interpretative guidance. SEC release number 338810 provides guidance for management's assessment process. So how the assessment has to be done is guided by this issue. PCAOB Audit Standard 5 provides guidance for the external auditor. So this one for the management, SEC's release. PCAOB Auditing Standard 5 gives external auditor. These two documents are not in conflict with each other. Of course, they have to go hand in hand. Both use a top-down risk-based approach. So bottom-up approach, there is another one called bottom-up approach that is not allowed. Top-down risk-based approach is used. What is top-down approach? First starting the entity level risks, the risks that are affecting the whole organization. Then going into the detail, the risks that will affect each activity, each department. So starting from the top risks, you move into the bottom risks. Top down begins with the risk assessment of the overall risks to ICFR. Make certain that the risks to the financial statements are identified and the risks are the focus of the testing. So basically risks, analyzing the risks. That is what they say. Top down and risk-based approach. Risk-based approach. Bottom up starts with looking at the individual processes and transactions. We don't use that. Which doesn't allow it? These two. SEC release number 338810, guidance to the management, as well as PCAOB Auditing Standard 5, guidance to the external auditors. Both suggest top-down approach, not bottom-up approach. SEC release. The guidance is organized around two broad principles. Management's evaluation of evidence about the operation of its controls should be based on its assessment of risk, which should be top-down. So risk-based, top-down. Management should determine whether it has implemented controls that adequately address the risk that a material misstatement of the financial statements would not be prevented or detected in a timely manner. So such risks, that means a misstatement, misrepresentation in the financial statements, if it is not identified, if it is not prevented, that's a risk. So how the management has identified or implemented adequate controls to avoid this? We need to evaluate this. You remember what we are talking about this, Sarbanes Oxley Act 404, section 404, that says management should do an assessment on the internal control systems. And also external auditors have to review the assessment of the management. So management, when they are doing the assessment, how that should be done, this gives the guidance, SEC release. So in that guidance, they are telling these points. Management's evaluation of evidence about operation of its control should be based on assessment of risk. So risk-based analysis has to be done in the assessment. And management has to decide whether to avoid this misstatement in the statements, misstatement in the financial statements, whether they have taken sufficient controls. Section 407. Each issuer of publicly traded securities must disclose whether or not the company's audit committee consists of at least one member who is financial expert. So remember, we said audit committee must have at least 3 independent non-executive members from the board of directors. At least one should be an expert. Others must be financially literate, but one should be an expert. So each issuer of publicly traded securities must disclose whether or not company's audit committee consists of at least one member who is an expert. If the audit committee does not have at least one member who is a financial expert, the company must state the reasons why not. If not, they must disclose why not. They have to say why they have not included an expert. If one expert must disclose the person's name and if they are independent. So that if you have one expert in the team, you have to disclose who that person is and if they are really independent or not. If more than one, the company may but does not need to disclose their names. If you have more than one, it's not mandatory. You can disclose the names or not. Definition of financial expert is a person who, through education and experience as a public accountant, auditor, or principal accounting or financial officer of an issuer of publicly traded securities, has an understanding of GAAP and financial statements and the ability to assess the general application of GAAP in connection with accounting for estimates, accruals, and reserves. experience in the preparation, auditing, or active supervision of the preparation of auditing and financial statements of generally comparable issuers in terms of the breadth and level of complexity of accounting issues. Experience and an understanding of internal accounting controls and procedures for financial reporting. An understanding of audit committee functions. So the expert should know all this. Basically, reporting, auditing, audit committee functions, internal controls. He should know all this. So these are the 7 sections that we study from Sarbanes-Oxley Act in our syllabus. Right. So what we saw so far, the FCPA, Foreign Corrupt Practices Act, and Sarbanes-Oxley Act regarding internal control. What do they say? What are the requirements? All that we have seen. Now let's go to the questions and see how many questions we can do from that. Here, there are only 14 questions. Which one of the following best describes an important provision of the US Foreign Corrupt Practices Act? Companies must follow the laws of the company's home country as well as laws of the countries where any foreign subsidiaries are located. Auditors cannot provide bookkeeping or other services. CEO and CFO must certify they have no knowledge of any corrupt practices occurring in any overseas subsidiaries of US companies. The internal accounting controls should be examined, and if material weaknesses are found, controls must be strengthened. Which one of the following best describes an important provision of the US Foreign Corrupt Practices Act? You remember under US FCPA, we studied 2 sections. One is about bribery, provisions regarding bribery. Second one was about internal control. That means you must have sufficient internal control to avoid the bribery. So D must be the right answer. Internal accounting control should be examined, and if material weaknesses are found, controls must be strengthened. A major impact of the Foreign Corrupt Practices Act is that registrants subject to Securities Exchange Act of 1934 are required to produce full, fair and accurate periodic reports on foreign commerce and foreign political party affiliations, provide access to records by authorized agencies of the federal government, keep records that reflect the transactions and dispositions of assets, and to maintain a system of internal accounting controls. Must be this one. We saw that in the theory. Which one of the following statements best describes the internal control requirements of US Foreign Corrupt Practices Act? Management must establish systems to provide assurance that transactions are authorized. All major cash payments and receipts must be reported to the no. It's unlawful to bribe foreign government officials to obtain retained business. It's unlawful to bribe officers and officials of foreign corporations to obtain retained business. Oh, that is wrong. Why? Which one of the following statements best describes internal control requirements? I missed that. There are 2 requirements. One is about the provisions of bribery related provisions. So the answer I selected comes under bribery. It's unlawful to bribe foreign government officials. But question is not about bribery. It's about internal control. The second requirement. What is second requirement? Maintain the records and have proper internal control systems. And the logic is, if you have proper internal control systems, bribery cannot happen, or it can be at least reduced. So A is right. Management must establish a system to provide assurance that transactions are authorized. A public corporation that must meet the provisions of Foreign Corrupt Practices Act should have a compliance program that includes all of the following steps, except an authorized and properly signed agreement that it will abide by the Act, cost-benefit analysis of the controls and the risks that are being minimized, a system of quality checks to evaluate the internal control systems, Documentation of corporations' existing external accounting control systems. Public corporation that must meet the provisions. An authorized and properly signed agreement that will abide by the act. We didn't see anything like that. An agreement saying that we will be abiding the act. Yes, there's nothing like that. According to the Sarbanes-Oxley Act, who is responsible for appointing, approving the compensation of, overseeing the work of registered public accounting firm? Must be the audit committee. Appointing the auditor is audit committee. They are responsible.